Hello, this is Dale. For the month of June 2020, I had 11 winning credit spread trades out of 14. What I want to do is just go over two of the winners. One was on the SPX weekly, and the other was Johnson & Johnson Leap. Both were bear calls during a period when the overall market was going up. So these were two trades that were going actually opposite from the major trend. My name is Dale Brethauer. I've been a trader for 35 plus years, hedge fund manager, guest speaker at a number of platforms, written 3 financial books, and I am the options coach mentor at www.optionsinfinity.com. What I see as the advantages of vertical credit spreads are you get great returns when they're coupled with a high probability of success. It can yield monthly income on a consistent basis. That doesn't mean you're not going to have losing trades. There will be losing trades. There will be losing periods. But on the average, you can count on month after month after month having consistent returns based on bull puts and bear calls, vertical credit spreads. Basically, what we're doing with credit spreads is we are selling premium. So the time is on our favor. If you're just buying a call or buying a put, the market has to go in the direction you think quickly, or the time will erode the value of the option. The intrinsic value of out-of-the-money options is based on time value alone. So the longer you hold on to that, the more that value decays. We're taking advantage of that. We are going to be sellers of premium, but we're never going to sell naked, because selling naked requires way too much margin. And actually, the return on margin is better for a credit spread because there is less required by the broker. Another advantage with credit spreads, you don't have to constantly watch the market. You don't have to chart hawk. They are low anxiety trades. They're not going to move a lot day to day to day. And because we're selling one and buying one further out of the money, you have protection from losses. In this chart, what I'm showing you is the rapid time decay during the last 30 days of an option, especially an out-of-the-money option, where the only value is its intrinsic value, and that is based on time. That premium erodes very quickly if the market does not go in that direction fast. We're taking advantage of that. Now, there's two different credit spreads. Today, I'm going to be talking about 2 bear calls, but we also do bull puts. And some of my past videos, and these are all on YouTube. If you go to my YouTube channel, if you type in Dale Brethauer, Brethauer, you can go to my YouTube channel and you can see a number of videos I've presented where we have had profitable bull puts. The bear call, first of all, is a type of option strategy used when you think you have a bearish situation. What you're doing is you're selling a call option at a specific price, and then you're buying the same number of calls at a higher strike price out of the money. Whereas a bull put is a bullish strategy when you think the market's going to go up. And that's when you construct one by selling one put while simultaneously buying another further out of the money. You know, another advantage of credit spreads is you know, if the market doesn't go in your direction, you actually, if it goes sideways, you can win. If it goes slightly down, you can win because we're selling out of the money. And if it goes in the direction, you win. So there's three ways you can win versus a straight call or a put. The first example is a bear call spread we put on the SPX weekly. This was put on June 19th, 2020, where we sold a bear call. We sold the 26th June 3205 and then bought the 26th June 3200 for a net credit of 95 cents. Now, a lot of people look at this and say, well, why not just sell this naked and capture all this premium? Well, if it goes against you, that's a tremendous amount of risk. Here we have protection against that. The net credit is 95 cents. Now, let's take a look at the chart. Now, why did we do this? Well, the SPX, and what I've got here is on the green lines and the gold lines, they are the regression channel, which shows the ±1 and ±2 standard deviation based on the regression channel. And you can see that the price was up around between the 1 and the 2, so it was overbought. So I'm looking for a bearish position. And I noticed that it indeed did come down and then came back up, and it kind of went from the ceiling to the floor, to the ceiling, to the floor, to the ceiling. It was channeling. I took advantage of it and put on a bear call right here in this position right here, and then watched it go down, came all the way down to the floor, came back up. It stopped right at the ceiling. I had plenty of time left. Then it came down to the floor again, and it busted through the floor and came all the way down here. At this point in time, the net debit was only a dime. I still had 2 days left before expiration, but I got out and captured 85 cents out of the 95 cents. And in my mind, that's the way to trade. Take your profit and move on for another day. By buying this back, what we did is we bought the 3205 call and sold the 3200 call and had a net debit of a dime. We had credit of 95, we got out with a dime, we got 85 cents profit, or $85 per contract, which is 89% of profit of credit. If you had 10 contracts, it'd be $850, 50 contracts, $4,250. The other thing I want you to notice is I go with a 5-point spread when I'm trading weeklies. In the next example, you'll see a 10-point spread because I'm trading a leap, which is further time, and I need to get that to get me a good credit. Now, this is an awesome trade, but I want to make a note that past performance is no guarantee of future results. However, like I mentioned early, in the month of June, we've had 11 out of 14 winners. We have been very profitable in the months of March, April, May, and June. Here's a bear call spread on Johnson & Johnson, J&J on May 13th of 2020. What we did is we sold a bear call. We went all the way out to 18 September, sold the 165 and bought the 175 for protection and took in a credit of about $1.11. Now, why did we do this? Well, you can see that J&J was trading up around the +2 on the regression channel, And when that happens, I'm usually looking for it to revert back to the mean. It did indeed do that, and it made what I call a measured move. And I can fully explain this on a lot of my YouTube videos. We got in right here. We held on all the way till June 26th when we bought this back for a net debit of 32 cents. Credit of $1.11, debit of 32. We made 79 cents profit on that. Now notice that not only did the measured move hold up, but we had a Fibonacci. It came down to the 127 of the Fibonacci. And the 5-day exponential moving average line was always below the 8. So we just carried it all the way down here. $79 on one contract. That's 71% profit on the credit. $790 for 10 and $3,950 for 50. Now, once again, past performances are no guarantee of future results. But what I'd like to do is show you our equity curve for all of 2019 and all the way up till the end of June 2020. And these are based on positions that I give to my members, the alerts that I give to my members on and by either a text or an email. When I'm making a trade, I alert them of that. You'll notice all the way back in 2019, we had a nice little run. Yeah, you're going to have some drawdowns. You're going to have some losing trades. This was the coronavirus. We had trouble getting out of a couple of trades quickly, and we did lose a couple there, but we quickly made that all back. And to date, we're moving very rapidly into a positive position for 2020. The overall equity line, you can see, is very, very positive. Now, in just a second on the screen, I'm going to have a green circle with a D in it. If you click on that, you will become a subscriber to my YouTube channel. I've got a lot of videos on there, educational videos, and also to the right of that will be an actual thumbnail of the beginning of a 12-part series where I actually will teach you how I trade and how I trade credit spreads, how I get in, how I get out, some examples. So I hope you take advantage of this, and happy trading. Bye-bye now.